Hello, this is Caleb Barney, local real estate agent here in the greater Cleveland, Ohio area. And today I wanted to go over an article from Bigger Pockets titled Investors, Stop Worrying About Interest Rates. Here's why right now is the time to buy. So this article came out a couple days ago from Chaley Ridge, who's the president and CEO of Ridge Lending Group. So she is a mortgage loan officer, or she's the president. She may or may not be the ones actually doing the loans, but either way, I thought that she had an interesting take here for investors as far as like, hey, everybody knows interest rates are relatively high compared to what we've seen in the past couple of years. Historically speaking, interest rates actually are not very high. So if you're looking at the average, the 30-year fixed right now, as of today, February 26th, from Mortgage News Daily, the national average for the 30-year fixed is 7.09%. For a 30-year FHA loan is 6.65%. And then obviously there are a bunch of different other loan types as well. But about 7% really isn't that high historically speaking. It just feels that way for two reasons. One, home prices have continued to climb, depending on the area that you're in, of course, but year over year, as a whole, in the United States, home prices have increased, and here in the greater Cleveland area, they've also increased. So home prices have continued to climb, and interest rates are higher than what we've experienced in kind of those COVID years, the unicorn years of 2020 to the first half of 2022, when we were seeing interest rates. Some people were getting them in the twos, but we were seeing interest rates basically anywhere from the high twos to the fours, basically. So what Chaley says here is there are 5 main reasons why she thinks it would still be a good time to buy if you're a real estate investor. So the first one is that current mortgage rates don't reflect the value of your loan over time. So she says, when you take out a mortgage on your investment property, ask yourself, will your mortgage loan be worth the same in a year? How about in 5, 10, or 15 years? And the answer is a definite no. And what she's talking about here is inflation. She's not even talking about a loan pay down for your property. So your loan amount, your loan balance will be decreased if you have a rental property and the tenants have been paying it down. Of course, in the beginning of a 30-year fixed rate loan, it's going to be more geared towards paying off interest as opposed to principal balance, but still your principal balance will decrease. But what she's talking about is inflation, and inflation numbers. The Fed targets 2% year over year. That means basically if you had $100 this year and then inflation was at 2%, that $100, really you'd have $98 worth of purchasing power next year if inflation went up 2%. So that same amount of money is actually worth less as time goes on. So that's one thing, or one reason why it always makes more sense to buy sooner rather than later. Not trying to time the market, but have more time in the market. Because as long as you believe in the fundamentals of the U.S. economy and thinking that, we are going to see steady inflation, basically your home is going to be and whether it's your home or, in this case, an investment property, is going to be your best hedge against inflation because you are getting a nice fixed rate loan for the entirety of the 30 years, meaning your principal and interest payments are staying the same, even though future dollars are going to be worth less and less as time goes on. So that's pretty sweet. Number 2, real estate investing pays off in the long run. Real estate investing is all about playing the long game. Even if you're planning on flipping and selling properties, we're still not talking about a get-rich-in-a-week scheme. although there is more risk to that, of course. But it says the fundamental fact that makes real estate a great investment is that it appreciates over time. Now, here's where I disagree with her potentially. It depends on where you're buying because there are some areas that are so rough and there's so much blight that your home may not be increasing in value or not considerably over time. And that's where I talk with real estate investors, not just about cash flow, but about appreciation. Because I personally like to invest in, you know, B or better areas. I like to invest in areas that I would feel comfortable living in or moving my family to if everything went wrong, and I would still feel safe enough living there with my wife and two kids. So, and the reason for that, other than having that backup plan, is because those home values increase greater typically than and more quickly than a home in a rougher neighborhood. So you might see 5% appreciation on a a B class area home, and you might see 0% appreciation or even depreciation in say like a D class area, because basically it comes down to supply and demand. And if there's too much supply because people are trying to move out of that area because they don't feel safe, because there's not jobs, whatever the reason there is, then you know basically you're going to need a lot more demand to offset that. So that's one reason why cash flow up front. Sure, you could buy a super cheap house and it could be cash flow positive, but if you just have one furnace that goes out or you have to replace a roof or anything like that, that just wiped out your entire year's worth of cash flow that you got for rents. And meanwhile, you're not going to be able to really increase those rents because, again, you're not attracting the a premium tenant. So maybe you have higher turnover. Maybe people don't want to stay there long term. So you can only charge so much for rent, and you're probably not going to be able to increase it that much. Whereas if you are in an A or B area, rents, as far as the rent to price ratio that you're buying, may be a little lower at first, but over time, with with your fixed rate for your mortgage payment, your rents should still go up, and then that will actually increase your cash flow from there. So, and you'll be experiencing more appreciation. So that's the cool part there. Um, she mentions that U.S. properties are consistently growing in value year over year. Depending on where you've invested, home values are still going up by as much as 9%. Again, in the areas that I serve most in the greater Cleveland area, it's been about 5% over the past year or so. So as far as there's absolutely no guarantee rates will go down substantially this year, I do agree with her there. She says if you're waiting for interest rates to go back down to the sweet 4% they were pre-2022, you might be waiting a very long time. I've heard some economists say that we might never see the low fours again. So you might be waiting a while for interest rates to go down. But while rates are widely predicted to come down at some point in 2024, this could mean only a modest cut. So the likelihood of rates reducing below 6% before the end of the year remains low. I saw a prediction from Fannie Mae, and I think that they are the only ones that I've seen with only big time forecaster that I've seen predict interest rates in the fives by the end of the year, and I think they're at like 5.9 or something like that. But I'm of the belief that we're going to be closer to 6.3875, something like that, because really, yes, I do hope that interest rates go down, but it's just going to be a bumpy ride in my opinion. And even though they went up really quickly, that doesn't mean they're going to go down very quickly, especially with the Fed trying to be a little more conservative and making sure that they're not going to uh, basically decrease their federal funds rate too quickly and spur on inflation again. When rates do come down, you'll be competing with regular homebuyers. That's absolutely true. So, again, as a real estate investor, a lot of times I like to zig when other people are zagging. So, she says that right now home sales activity is at a 28-year low. And that's pretty good news for an investor, especially if you could find off market properties. Um, because a lot of times when interest rates do come down, that's just going to open up the floodgates, and there's going to be this pent up buyer demand that's ready. They're chomping at the bit to get their dream home, and they're going to be willing to pay more than you as an investor will be. So, something else to consider there. And then higher interest rates aren't always a bad thing from a tax perspective. I think that this is just Chaley trying to basically massage some of the pain away. No, I don't like higher interest rates. Yes, you can write them off. So at least that's the saving grace there. But because if you're an investor, mortgage interest is tax deductible as an expense on your rental income. So yeah, it's not all bad, but again, I'd much rather see the lower rates. But yeah, I mean that's basically what Chaley is talking about here, as far as why you should stop worrying about interest rates so much as an investor. If you can make it pencil out, then and it's in a good area that you want to buy, it aligns with your goals. Then I say, sure, go for it. Buy real estate, continue to buy real estate, and wait. And again, have more time in the market as opposed to trying to time the market. So, if you have any questions about the greater Cleveland area regarding housing or anything like that, feel free to reach out to me. Otherwise, have a great day.